Buzzsaw, Matt, what is happening, guys?
Hey, Jared.
Hey, what's up, Jared?
Feels like we've been waiting forever for this, right? One big beautiful bill act. It's a mouthful there. The O triple B is what everybody's calling it, right? That is official, signed on July 4th into law, I guess. And what we want to do, you guys have seen several of our videos kind of leading up to the anticipation of this. I'm not gonna lie, I didn't anticipate this get across the finish line. I don't know about you guys. I should say not across the finish line. I expected to get past, but maybe not by July 4th. But where's you guys' heads at?
Yeah, I thought it would take all summer, but to have it passed by the original deadline of the 4th was a surprise and good to finally get it out of the way.
Yeah. What do you think, Matt?
Yeah, agreed. When they originally set that deadline for July 4th, I was a little hesitant about that. And then we heard whisperings of Labor Day and, now maybe it'll be December. So nice to see some resolution there.
Agree 100%. I will say, as a tax consultant, as a tax firm, right, as a advisory firm here, it's pretty nice to know the rules now. Even though we're halfway through the year and now we get the rules, it's a whole lot nicer to know the rules now as opposed to December. And then you're playing with just a couple deals. So what we want to do today, guys, again, we could probably do 2 hours on this thing, to be honest with you. We're going to try to keep this very short. 30 minutes max is our goal. I probably shouldn't have said that because now we're going to go 45, but try to keep it to 30 minutes max if we can, and really just unpack kind of the guts of this bill. We're not going to cover everything. Again, that would put us at the 2 hours. We're focused here strictly on dental practice owners. So really picking out the bigger pieces of the bill that it pertains to. And real fast, you guys have seen myself, Jared, on here. You've seen Ryan Hatch, director of tax here at the firm. I call him Buzzsaw half the time. I call him Ryan the other half. So Buzzsaw, Ryan, same person. But we do have another guy on the screen. This is Matt Molotok, tax consultant here at the firm. Super, super knowledgeable. And we need this guy on here to help us unpack this. So Matt, we appreciate it, buddy.
Yeah, great to be here.
All right, let's dive in, right? Feel free to chime in as we go, guys. So basically this one big, beautiful bill act, we'll call it the O triple B is what everybody's calling it. I'll just start off high level details, then I'm going to throw it to these guys. But this was passed by a super slim margin in both the House and the Senate. You guys saw in the Senate where they actually has to bring in the vice president to break the tie of 50-50 so it could pass from a 51 to 50. So it's not bipartisan at all, basically, but that's how it passed by a very slim margin. A lot of what we're going to be talking about today, guys, you're going to hear the word extend or permanent a lot, right? It extends a lot of those expiring provisions from the Tax Cut and Jobs Act back when Donald Trump was in office. A lot of this is just an extension or making a lot of it permanent, if that makes sense. And then high level, it also addresses a lot of other tax priorities that the Trump administration have. A lot of it, you're going to hear the no tax on tips, no tax on overtime, Social Security, all that. We'll kind of unpack that a little bit. But then also it terminates a large number of the clean energy tax incentives. They kind of rolled a lot of that stuff back. Again, I'm not exactly sure how they make all this stuff balance. I don't know if it really ever balances, in my opinion, but they got to find a way to pay for a lot of these tax cuts. So just high level, if you're talking to your buddy at the bar and want to sound really cool, hey, these are the three things, high level, what happens in this bill. So what we've done, and Matt, I'm going to throw it to you, man. What we've done is broken this down between basically two high level provisions on business. So think about how, some of these tax changes affect your business. And then Buzzsaw will throw it to you to really unpack the individual side, if that makes sense. And then I'll wrap it up. But Matt, I'm going to throw it to you, man, on this business side. Let's jump in on the first aspect and roll into it.
Yeah, sounds great. Thanks, Jared. So, as you see there, 100% bonus depreciation is back for property acquired and placed into service after that January 19th date. And we also see that Section 179 cap get raised to 2.5 million. So, as this pertains to dentists, you guys know dental practices are super capital intensive, right? So dental imaging equipment, chairs, cabinets, you name it, they're not cheap. And this provision turns those big expenses into immediate tax savings. From a cash flow planning perspective, being able to expense everything up front gives you a whole lot of flexibility, especially if you're having a high income year and you're trying to bring that tax bill down. So this applies to tangible personal property. So kind of like the stuff I mentioned before, computers, dental tools, furniture, and even some improvements to non-residential property. So stuff like new HVAC, plumbing, maybe lighting, maybe you put a drop ceiling in. The bonus depreciation is automatic, so it kicks in unless you opt out. And if you opt out of it, it's opting out of everything. Section 179 has more limitations. You got to be profitable. There's a cap on it, but it does let you cherry pick assets. So that's helpful if you want a little bit more control over what gets deducted.
Yeah. One thing here too, I mean, and maybe you said it, but like bonus is back. I just anticipated, sure, bonus is back, right? But like bonus is back, but it's permanent. For the past several years, we've been talking about that stair step, right? From 80 to 60 to 40. Now this thing is back, but there's no stair step down. Is that right?
Right. Yeah, that's correct. All the way through 2029.
Yeah, that's big. And then yeah, the section 179. Anything, Buzzsaw, you want to add here on this one? I mean, it's fairly straightforward. This is probably the biggest one you heard, like going into it, is like, man, bonus is coming back. 100% bonus is coming back. It's back. Interesting on that date, Buzzsaw, January 19th. I mean,
Yeah, you'll
very
know. I mean,
specific, right?
it's inauguration day. So anything after inauguration day is eligible with that 100% bonus. Anything before that, you're going to be stuck with the old rules. Some of the potential nuances to think about is if you're under contract on some sort of equipment or construction before that date, there's going to need to be some guidance on how that affects things. But right now, if you bought it, purchased it, everything after January 19th, you're in good shape.
Yeah. And I should say at the beginning here, I should have disclaimed all this at the beginning, right? If we're not your CPA, if we're not your advisory firm that you use to get all your taxes, planning and projections done and prep, reach out to your own CPA to figure out how this pertains to your specific situation. We're not giving advice or anything here. We're just kind of going through. Education is what we do, right? So I think this is an educational deal in that regard. Sweet. All right, bonus is back. We'll get the t-shirts made. Let's jump on to the next one here. R&D, Matt. What in the world changed here?
Yeah, so this is a huge one for a lot of dentists, especially if they have done R&D in the past consistently. So starting in 2025, as you can see there, the expensing of those expenses is made permanent. And then we do have that correction mechanism or provision for 2022 through 2024. So either you can amend your prior tax returns or you can catch up that amortization in 2025 and make an election to do that over 1 or 2 years.
Yeah.
So what I will say is the IRS's definition of R&D way broader than most people think. So, trying new materials, procedures, developing, refining in-house workflows, experimenting with new techniques, custom software development. If you build your own custom patient portal, that's a qualifying activity. So as of 2017, when the TCJA passed, or TCJA rather, starting in 2022, that R&D had to be amortized over 5 years. And that hit a lot of small businesses, a lot of our clients as well, who weren't aware of that change happening. But with the new bill, obviously you can expense it all up front and that's permanent. So that'll be a major cash flow boost for the dentists who qualify. Now, this retroactive opportunity to fix it, we're still kind of awaiting some IRS guidance here because I don't think they're going to want to see all these amended returns. So that second option seems to be the simpler one, just kind of roll it all into 2025 and take the expenses there. But we're just going to have to kind of wait and see what the IRS tells us on that one.
Yeah. We've never seen this before to a degree, but Buzzsaw, maybe jump in just a little bit. I mean, if you took advantage, I guess, or maybe you utilize the R&D credit, which a lot of our dental clients did over the past several years, this is a big deal, right?
Yeah, I mean, we saw hundreds of thousands of dollars of lost deductions for those that were taking this R&D credit over the past 3 years. And to be able to pick all that back up, either through amendments or on your 25 and 26 returns is going to see some massive tax savings.
Yeah. So if you guys are listening to this right now, I mean, and you've taken the R&D credit, really, I'm pointing at the screen like you can see it, 2022 through 2024, your ears need to perk up, and you need to get with your CPA who prepared those returns and say, I heard I'm going to call it an R&D fix, and go figure out what that means for you on how to fix this. Might be a little time, like Matt referenced, till we figure out the exact fix for you, whether it's A or B or what the IRS comes out and says. But this is a fix that helps those people that utilize those credits specifically during these 3 years, this age range. So this is the last bad dad joke. Front of the t-shirt, bonus is back. back of the t-shirt, R&D is fixed. So I'm loving it. We're actually going to make t-shirts, guys. All right, let's dive in. Excess business losses, Matt. What we got here, man?
Yeah, sure thing. So this EBL cap, or the excess business loss cap, will become permanent. So it's going to be $626,000 for joint filers. And my understanding, Jared, is that amount gets indexed for inflation, so it could increase in subsequent years.
Yeah.
And then the excess gets converted to something called a net operating loss. So basically, we take all of the aggregate losses from all your trades or businesses. So whether or not they're disregarded entities or pass-through entities. So if you own multiple practices, maybe you have a DSO structure, maybe you're investing heavily in real estate or equipment, those write-offs could push you into a really large loss on paper, and you could have a pretty good tax year there. What I will say though is you can't offset non-business income beyond that cap. So if you've got a large W-2 income, maybe you've got a pretty significant investment portfolio, you may lose some of that offset power that used to be allowed.
Yeah.
So this NOL will roll forward basically, and it can be used to offset future business income or future income, period, 80% of it. So that means that strategic timing of deductions kind of becomes more important with this cap. You might want to spread out losses or defer deductions if you're bumping up against that cap.
Yeah, and there's a lot of chat. I mean, we see this, I don't know, we see it routinely, like where these EBLs, excess business losses, come into play. And there was some chatter. I don't know if it was in the House or the Senate, or I kind of lose track of what was what. Now it's final, so we can talk about it. But I mean, Buzzsaw, they were talking about changing it a little bit on how that worked. But if it feels like nothing really changed here, just the permanency kind of kicked in.
Yeah, the original House bill was, and instead of reverting excess business losses to NOLs in the previous and in the following year, they were going to stay as excess business losses, but they got rid of that provision. It's going to stay status quo, so everything will convert to an NOL going forward, which is good news for the taxpayer.
That's right. Okay. Good deal. All right, Matt. Elimination of clean energy incentives.
Yeah, this one's kind of the most immediate and abrupt, right? So we see a bunch of green energy credits ending. Some of them end at the end of third quarter there. Some of them end at the end of the year. So those clean vehicle credits for the personal and commercial vehicles, those are done as of September 30th. And the home and residential energy credits end on the 31st. So that includes that $7,500 credit for EVs, again, personal and commercial. That includes that up to 30% credit for stuff like solar panels, geothermal pumps, battery systems, energy efficient windows, et cetera. And then the residential energy efficient home credits. So, if you were building your own practice facility, or if you had some rental properties, those will no longer benefit you. So if you are one of those dental practices that's kind of really conscious of that sustainability and that energy efficiency, now's the time to pull the trigger on those improvements, because the credit cut means those investments become way less attractive at the end of the year. So timing really matters on this. For the EV, you've got to take delivery of it by September 30th. It's not a matter of you walk into the dealership and order it and pay for it. You essentially, it's got to be in your driveway. You got to be able to drive it by that September 30th date. And then for the solar and clean energy upgrades, everything has to be installed and operational by the end of the year.
Yeah. Anything to add there, Buzzsaw? I mean, again, this was a big way to pay for it. A lot of these clean energy incentives just kind of rolled back.
Yeah, I mean, it's just a way to pay for some of the tax savings elsewhere, is getting rid of these credits earlier than anticipated.
Yeah. Perfect. Let's keep going, guys. Individual side, Buzzsaw, we'll throw it to you, man. A lot here on the individual side as well. And again, like I said at the beginning, we are not covering the entirety of this bill. We're pulling out the stuff that we think pertains directly to our clients, which we serve dental practice owners. So, Buzzsaw, I'll throw it to you, man.
Yeah. So like Jared said, we're going to talk a lot about things just being made permanent from the TCJA. The first one of those is the tax brackets. So those tax brackets you've been used to for the past 6 or 7 years, those are now made permanent. You're not going to see really any changes there, no tax savings from new brackets or anything. It's just a continuation of the current brackets. Otherwise, they would have gone up. Tax brackets, tax rates would have gone up, but with this being made permanent, it'll just kind of be status quo, business as usual on the tax brackets. Same thing with the standard deduction. That's been the increase to that has been made permanent this year, up to $31,500 for married filing joint taxpayers, adjusted for inflation going forward.
Yeah, and I think you said it well. Maybe you should have said this at the beginning, maybe in the high level slide that I went through, but most of these tax cut and jobs, TCJA, let's call it, provisions that were put in there back in the day. They were sunsetting, right? And so a lot of this is making those permanent as opposed to getting bumped back to where they were previously. Does that make sense?
Yeah, it would have gone, the tax brackets would have gone back to 2016 levels
Yeah.
had this bill not passed.
Yeah, which I'm terrible with rates, but I mean, now we got a high 37% rate is the highest, I guess, from a federal side. I think it was like 39.6 before then or somewhere in there, right?
39.6 is where it would have gone to, yeah.
Yeah. So a lot of what this did just kind of locked it in instead of bumped up. Matt, anything to add there, brother?
I think Ryan covered that one really well.
All right. Jumping in here.
Yep. So as part of these permanent extensions, personal exemptions are done away with. They kind of took away the personal exemptions and increased the standard deduction as a way to help offset that. That's what we just talked about. However, if you're 65 or older, you get a temporary $6,000 additional deduction to your standard deduction. And that could be up to 12 if both taxpayers on a married filing joint return are over 65. It is temporary through 2028, and it does phase out at 75,000 for single taxpayers and 150,000 for jointly filing taxpayers. And then the last thing here, the child tax credit has been increased a little bit up from 2,000 to 2,200, and they've added an adjustment for inflation. It had been 2,000 every year. Now it's going to be 2,200 starting in 2025 and adjusted for inflation every year going forward.
Yeah. Matt hit a little bit on it. If you know, on number two, maybe a little bit, you know, because you heard during the campaign trail or whatever, no tax on Social Security. We're not going to talk about that past this slide because this is kind of the solution to no tax on Social Security a little bit. I don't know if it is exactly, but hit on that just a little bit.
Yeah, so I mean, this can definitely apply to, semi-retired, dentists or their spouse if they're under the income cap. And planning around AGI will help retain the deduction. So if you have a big Roth conversion, or maybe you're selling your practice, that would be the year that you're, eligible for that. And then the deduction is per taxpayer, Jared. So married seniors could get 12,000 total on that.
Yeah. So really, there's no fix. We'll talk about no tax on tips and overtime in just a second, but this is the fix, if you will, for no tax on Social Security. Social Security is still taxable. I'll say it that way, just as how it always has been. Now, if you're 65 or older, in these 3 years, I guess that's 4 years, 2025 through 2028, you get this temporary additional deduction, if that makes sense. So that's kind of how that plays out. Change to tax. All right, love it. Let's go. Oh man, salt, buzzsaw. Unpack
yes.
salt, man.
This was the biggest contention point between the House and the Senate. We have a temporary fix to the $10,000 salt cap. It is going to be $40,000 through 2029 now. However, it does have an income phase out at $500,000. That $40,000 deduction starts to decrease, and it eventually phases back down completely to 10,000, somewhere around 600,000 of income. And then again, I'll say permanently until they make another tax bill, it's going to be back down to 10,000 starting in 2030. So a temporary increase there to 40,000, but it's not a permanent fix to the state and local tax cap. To kind of piggyback off of that, though, if you do have a business, a pass-through business such as an S corp for your dental office, that pass-through entity tax that we've been taking advantage of is going to stick around. There was some chatter about getting rid of it or capping it. However, status quo on the pass-through entity tax, it will stay as a workaround to the salt cap.
Yeah. And again, as you heard through all our several videos before this, salt, PTE, if you will, was all a point of contention. Like the House wanted it this way, the Senate wanted it this way. Sounds like they kind of met. I don't know if this is meeting in the middle, but they got the increase, if that makes sense. But then it phases back down to the original one. But the good thing is no change to the PTE like they were talking about, because that was going to be very punitive, in my opinion, on how it was going to stick it to the business owner a little bit, in my opinion. What do you guys think?
Yeah, it was glad to see that not adjusted for and staying in as a deduction that can be taken advantage of by our pass-through businesses, because there's substantial tax savings to be had with that deduction.
Yeah, exactly. And Matt, I guess it's fair to say a little bit, and I'm just speaking out loud here, like with a lot of our clients, I mean, the PTE, like you mentioned, Ryan, is kind of the workaround. If you're getting hit with that salt limitation, which most of you guys are, that we're working with, the dental practice owners. I guess it's just work with your CPA to kind of see, are you gonna, now that they've raised it to 40,000, are you still going to get limited? Would you have more and then continue the PTE work around? You just kind of have to strategize there, right?
Yeah, absolutely. The biggest thing though is that $500,000 phase out. That's going to help a lot of small business taxpayers, I think.
Yeah, that's right. Yeah, the phase out from 5. Yeah. And then back down in 2030. That's the key. So that's that sunset stuff we were kind of talking about with tax cut and jobs. This is not permanent. Not permanent. This is going to go back down, right, Buzzsaw, in 2030, back to
Yep.
where it was before. Okay. All right. So last bad dad joke. When you're wearing your t-shirt and talking to your buddy at the bar, if you throw out salt, you really know what you're talking about on this act. So just say, hey, what about those salt changes, and see what they say. All right. QBI, Buzzsaw, unpack this a little bit.
Yep, so the QBI deduction, it had been talked about maybe increasing it from 20 to 23%. They didn't end up doing that. It's going to stay at 20%. If you recall, this is a deduction that you can take on your business income. So the profit coming through on your S Corp or your Schedule C, however you're taxed, the profit from your practice. There is a phase out though for specified service trades or businesses. So some of you that have higher income aren't able to take this deduction. However, they're changing how that calculation is done. So there may be more people that are able to take this deduction, but it's going to stay at that 20% number going forward. And going forward, it's permanent.
Yeah, that's right. Matt, anything to add on that one, man?
No, I just wanted to mention, I guess, that it allows income aggregation across multiple practice entities.
Yep.
And the income limits still apply, like Ryan said, but they're a little less harsh than they were before. So, and high income dentists still benefit potentially. The phase-in's been widened. More of your income might qualify with the right planning. You could certainly qualify.
Yeah. So a lot of planning around this one. Again, this is probably the big one that came out of the Tax Cut and Jobs Act that is now permanent, right? This is made permanent. Percentage didn't change. You still got a 20% deduction, 199A, whatever you want to call it. So still 20%, but now just kind of permanent and kind of widened the ability for other businesses to get in there. So nothing but good things there, I would say. All right, estate, gift tax, AMT, man, I don't know if we want to explain AMT. Let's just stay on estate tax and gift tax, maybe.
Yeah. So the Tax Cuts and Jobs Act really increased the estate tax exemption and gift tax exemption. That has been made permanent now too. For 2025, it's going to be 30 million as exempt for estate tax for joint filers, and that's going to be increased for inflation every year. So if you need to do estate planning, it's going to be for those that have an estate more than 30 million.
Yeah, and then the AMT, I mean, AMT, get with your CPA if you got alternative and minimum tax issues. I mean, it's kind of confusing. I'm not even going to try to explain it, but basically, you got some permanent extensions here with what was done in the Tax Cut and Jobs Act on those increases. So, pretty straightforward there, I think, guys. All right, here's a couple, maybe one new one here, but something we've really never seen before. So unpack this a little bit, Buzzsaw.
Yeah, start off with mortgage interest. So, for the past several years, any mortgage balance in excess of 750, you'd have to kind of prorate that interest. You could only deduct up to 750,000. Let's say your mortgage was $1 million, only 75% of your interest could be deductible. So that's a permanent limitation there at the 750 mark. And then also, if you have a home equity loan, you cannot deduct interest on that home equity loan unless if it was used to make substantial home improvements on that personal residence. So if you're taking it out for a vacation or anything else but home improvements, that interest is going to stay non-deductible. And then the new one, like Jared mentioned here, is the car loan interest deduction. So this is a temporary deduction for 4 years from 25 through 28. It has to be a new car loan, so a loan that you take out this year or in one of those 4 years. It's got to be for a personal use, so it's got to be your own personal car. Has to have its final assembly in the United States, and there is an income phase out, $200,000 for joint filers. And I believe the deduction is up to $10,000 of car interest.
Well, that's good to know. Yeah, that car interest is something new, right? That we really haven't seen before, in my opinion. Matt, you have any comments on this one?
No, it's just kind of good to know that used vehicles will qualify as well, as long as those other qualifications are met. It doesn't seem like it needs to be a new vehicle. It's just the loan needs to be new.
Yeah, And the first two there on that interest, I mean, that's just kind of making those things permanent. Back in the day, you could take out a HELOC and buy a motorcycle, if you will, and deduct the interest. Now you can't do that. I wouldn't say now. Tax Cut and Jobs Act change that. Now that's kind of permanent. So must be used for home improvements. This is interesting here. You can see final assembly in the United States really pushing, right? Pushing to that manufacturing in the United States deal, incentivizing that. So that's going to be very interesting to figure out what car, or if your car is have a final assembly in the United States. Seems like an administrative nightmare, but we'll see what happens, guys.
Yeah, I hope there'll be a database out there for us to cross-reference.
I'm hoping there'll just be a box checked on the form, right? Like yes or no.
Yeah.
We'll see what happens. All right. Next couple here, Buzzsaw. Oh, my bad. All right.
Yep. Dependent care changes. So historically, you'd have to take all of your dependent care expenses and you could take a credit up to 35% of those. Now it's up to 50% with the Tax Cuts and Jobs Act. That 50% has been made permanent. So now of course, there is a cap on the credit you can take, but it's up to 50% of your qualifying dependent care expenses, up to $3,000 for single filer and $6,000 for joint.
Yeah, another kind of one of the Tax Cut and Jobs Act deal made permanent, which is good, right? I mean, the dependent care, I mean, for people to work and pay for that dependent care, that's expensive. So getting a credit there is spot on. All right, campaign trail stuff right here, man. No tax on tips, no tax on overtime. Again, we're gonna go into all of the details here, but thought we just mentioned kind of what changed on these two things.
Yeah, so this is something like Jared said, we've heard a lot about on the campaign trail, no tax on tips or overtime. This is now a temporary deduction through, again, these 4 years, 25 through 28. So you can deduct up to $25,000 of your qualified tips and up to $25,000 of your overtime pay. That's for joint filers. And they do have an income phase out on these as well, 300,000 for joint filers. Once you hit that, your ability to deduct those tips and overtime pay is going to be diminished.
Yeah. So you got limits on them for sure. It's not the entirety of your tips. Matt, any comments on this one here?
That was pretty straightforward.
Yeah.
To be frank, I don't see it affecting a whole lot of our dental clients.
Yeah, agreed 100%. Agreed 100%. But thought we just kind of mention it, that this was something in the bill that might pertain to somebody if that makes sense. So again, you're seeing a lot of this 2025 to 2028, and in every big tax bill, right? Go back to the Tax Cut and Jobs Act. You're going to see those ranges of years until things change, or it's not made permanent, but it is in effect for a certain amount of time and then goes back or reverse back. But a lot of these things are permanent, but a lot of these things you're gonna see these ranges here of this 4-year period. All right. We're getting there, guys. I promised 30 minutes. We're close. All right. Trump accounts. What in the world's a Trump account, Ryan?
Yeah, Trump account. This is a new account. Will act as a traditional IRA, but this is for minors. So it's for the exclusive benefit of those under 18. You can have one Trump account per child and make a $5,000 annual contribution to that account, and that'll be adjusted for inflation. One little bonus here is that kids born between 25 and 28 can get $1,000 kind of tax credit, we'll call it, deposited into their account when they open it. So a way to kind of get these accounts jump started for children born here within the next 4 years. And then, it'll act as an IRA, but those contributions are not tax deductible by the parents if you're putting money into those. However, the earnings in them grow tax free.
Yeah, that makes sense. So do we see a rush for babies here in this to get the $1,000, or the kids probably cost more than the $1,000, right?
Yeah, yeah. We'll see what happens there on the birth rate.
Matt, any comments on this feedback?
Am I correct in saying that for our dentists with grandkids, they could open one of these accounts for their grandkids and still make that $5,000 contribution with that $1,000 kicker?
It's a great
Yeah,
strategy.
yeah, you could, yeah.
Yeah, that's a great point, Matt. Strategize, right? I mean, there's probably some way you can take advantage of this and put it in place. So yeah, I think you're fair in comments there. That's good.
And then, yeah, some additional expenses are now qualifying for 529 plans. So if you have one of those accounts for your children, you can now pay for enrollment and attendance fees at elementary or secondary schools, and qualified post-secondary credentialing expenses are now something that you can pay out of your 529 plan.
Yeah, it seems just over the course of time, they're kind of expanding, eligible expenses that are able to be paid out of there, which is always good stuff.
That one kind of sneaks in there, but we have a lot of clients who have
Yeah,
children in a private school or post secondary credentialing, and so having that 529 money being able to be utilized for that is huge.
yeah, that's 100% right. Okay, that's the administrative provision side. Just a one quick slide. I'll just jump through these real fast. So just this first one here, Form 1099, right? So you send a 1099, my simplistic brain, you send a 1099 out to individuals that have, contract labor, etc. $600 or more. That's kind of the threshold that has always been in place. Now they've bumped that up to $2,000. So hopefully that's less paperwork. If you think about it, that business owners are going to have to do or have their accounting firm help them do in regard to that. But the key thing here, $600, and correct me if I'm wrong, guys, but $600 is still in place this year. Nothing changes. That kicks in next year. Is that right?
It's my understanding too. Yep.
Yeah. So just a little change there. And the ERTC, and Buzz, I'll throw it to you here a little bit on the ERTC enforcement, but explain kind of ERTC, employee retention tax credit. I'm sure you've heard about it, but just hit on what kind of changed here administratively on that.
Yeah, the main thing to know here is if you are one of those taxpayers who made an ERTC claim and has not received it yet, if you made your claim after January 31st of 2024, do not expect to receive that refund, that tax credit coming back to you. That's kind of issued the IRS to stop I guess paying out those claims for those that were made after January 31st, 2024. If you made it before, still a chance that you could receive that money, but anything after that, the IRS is now going to be done processing those claims.
Yeah, that's perfect. I mean, I'll stop sharing here just real fast and just kind of wrap it up. But I mean, you can, and again, I'll say it again. We did not cover the entirety of the tax bill. There's a lot in the tax bill, right? I don't know how many pages, guys. You have any idea? I haven't even seen it. I mean, it's unreal how many pages some of these things are. But I think the overall thing is we wanted to hit on what pertains to our dental practice owners, high level. And I think the big thing is, and Ryan, Matt, you can kind of end it here, but like now that we know the rules, now it's time to strategize. Let's see what we can do here for the rest of the year. Big thing on the R&D, I think, for a lot of our clients on how that's going to work. So again, have your ears perk up a little bit. If you took the R&D credit on those 3 years, 2022, 2023, and 2024, and look at the R&D credit going forward because the fix is back there on that. Bonus is back. I mean, it's a big deal everybody's talked about, but I'll just say strategize. You know what I mean? Get with your CPA, figure out how this affects you, if you can do anything differently and how it's going to help you. Matt, you have any comments there here to kind of wrap us up, man?
No, it's just kind of like you said, now that the goalposts seem pretty fixed, it's going to be way easier to, do multi-year tax planning, and I'm excited about that. So,
Yeah. All right, Ryan, wrap us up, man. Any comments from the wise buzzsaw?
Yeah, I mean, like you said, it's always nice to know the rules of the game. Nice to know at mid-year 25 what the rules are for 25, and like the big thing, just it's now time to start strategizing, particularly around R&D, bonus, SALT, PTE. Those are the big things from this bill that we can start to strategize with and help save you taxes.
Yeah, specifically on the R&D, I'll end it on that. Like, I think, Matt, maybe you've mentioned this when we were on that slide. We're expecting some IRS guidance on how a couple things are going to be treated. We've kind of got the guts of the rules, but we need a little bit of guidance. Just go in, analyze what makes the most sense for you to do. But OBBB is now in effect. If you guys have questions out there, let us know. Again, we're going to be meeting with all our clients. We're going through tax planning right now. I've started since June, so all our clients will be hitting on. And if you guys have questions just out there, ping us. Happy to help. Again, I'm just kind of here moderating. These guys are the smart guys in the room, to be honest with you, that know exactly what's going on. So Ryan, Matt, appreciate you, man. And appreciate your time. If you guys have questions out there, let us know. We'll see you guys. Talk soon.